The global oil market is entering dangerous territory as the Strait of Hormuz crisis enters its seventh day, disrupting one of the world's most critical energy routes and sending prices sharply higher. During trading in New York, West Texas Intermediate crude surged past $85 a barrel, while Brent crude climbed close to $89, putting oil on track for its largest weekly gain in 4 years. The surge is being driven by a near-total collapse in the tanker traffic through the Strait of Hormuz, the narrow waterway that carries about 20% of the world's seaborne oil supply. Satellite tracking shows that no tankers passed through the main shipping lanes for nearly 48 hours, compared with the usual 20 to 25 vessels per day before the crisis escalated. More than 150 oil and LNG carriers are now anchored outside the strait, unable to move through the region safely. 2 tankers have already been struck by Iranian drones, killing 2 crew members and setting fires aboard. Insurance costs for ships attempting the route have exploded, rising from about $10,000 per voyage to about $250,000. A shipment-stalled floating oil storage has surged by about 15 million barrels, putting additional pressure on refineries in Asia that rely heavily on Gulf supplies. At the same time, energy officials in the Gulf are warning the crisis could get much worse. In an interview with the Financial Times, Qatar Energy Minister Saad al-Kaabi said Gulf energy exporters may be forced to declare force majeure and halt exports entirely if the conflict continues. Qatar has already stopped LNG production equal to about 20% of the global supply after the strikes on its facilities earlier this week. Al-Kaabi warned if the Strait of Hormuz remains closed, oil could hit $150 a barrel and gas could surge to $40 per million BTU within weeks. He also warned the wider consequences for the global economy, saying rising energy prices could trigger shortages of key products and disrupt factories worldwide. Analysts are now rapidly revising their outlook for the global energy market. Before the conflict, many banks expected an oil surplus in 2026, driven by higher production from OPEC Plus and US shale. But those forecasts are now being scrapped. Instead, analysts are warning of a supply deficit of 3 to 5 million barrels per day, with disruption equivalent to losing an entire output of Iraq, along with Qatar's LNG exports. Several energy facilities across the Gulf have also been hit, including the UAE's Ruwais refinery, Saudi Aramco pipelines, and Qatar's Ras Laffan energy complex. The shock is now rippling through financial markets as well. On Wall Street, the Dow Jones fell more than 600 points, while the Nasdaq dropped more than 2%, as investors reacted to rising oil prices and weaker economic data. Stock markets across the Gulf also tumbled. Saudi Arabia's Tawai index fell more than 4%, Dubai dropped nearly 4%, and Qatar's stock market slid more than 5%, the region's steepest declines since the pandemic. Meanwhile, the shipping authorities are saying more than 150 vessels remain stranded near the Hormuz, while Iranian's Revolutionary Guard has warned it could set fires to ships attempting to enter the strait. For now, the US Navy is considering escort missions but have not yet activated them, while several Gulf oil and gas facilities are partially evacuated staff. The bigger question now is how long this disruption will last, because if the strait stays closed for weeks, analysts say the world could be facing a major energy supply crunch and a new global inflation shock.